Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend James Boyd. He's a 20-plus year veteran of the financial markets. He's there to help answer your questions. Great educator in his own right. So participate in the conversation, whether you're here live or whether you're here in the recorded version. We'd love to hear from you. Ask a question in the chat. If you're in the recorded version, leave a comment in the comment section. We love to hear your comments and conversations. So we're going to jump in today. We're going to talk a little bit about index options. We're going to talk about what's going on in the market, the fact that we've got a Fed day today. And boy, I'll tell you what, that has resulted in some interesting changes in the market on previous Fed days when we've been talking. They always seem to fall on a Wednesday, so we'll see if that remains the case here today. We'll manage our 14-7 strategy, and we'll see what else is afoot. But a couple of quick housekeeping items as we get started here. Remember that everything we talk about simply for illustrative and educational purposes only. No part of this presentation be construed as any kind of a recommendation or advice. Remember that investing involves risk, including the loss of principal. Past performance, no guarantee of future results. Now, when trading equity and index options, make sure that you are aware of the fact that they carry a high level risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Also, remember, we're talking about multiple leg strategies here. Potentially, those can carry with them additional transaction costs. Be aware that in most cases, spread trading will be required to be done in a margin account. Now, the trades that we're going to be looking at, the specific index options that we're going to be looking at are primarily European style options, which means that they cannot be exercised until expiration, as opposed to most equity options, which are American style. Remember that anytime you are short an American style option, there is the potential that you could be assigned early. Now, we're going to be using the thinkorswim desktop software platform, specifically the paper money version of that platform. Great learning environment, not a guarantee of future success out there in the real world, but it does not do certain things the way a live trading account would do. One of those is allow for the early assignment of American style options. But since we're talking about index options today, and specifically European style index options, we don't have to pay attention. We don't have to worry about that as much, but it is something to keep in the back of your mind as you continue to move your trading and expand your skills. So remember that Schwab doesn't recommend the use of technical analysis as a sole means of investment research. There are other ways to look at the market. They are all theoretical in nature, so be aware of that. Let's jump into this discussion today and see what is going on. I'm going to pop over here to the thinkorswim desktop software platform. Good opportunity for me to remind you to click on that subscribe button down at the bottom of the page. Give us a follow if you have not done so already. It allows you to set up alerts for new content that drops. And it makes it a little bit easier to find things, and it's at no cost to you. So we'd love to see you doing that, clicking on that subscribe button. Also, you can follow me. You can follow James Boyd on X, at Ben Watson CS. James is at James Boyd CS. You're going to find us out there along with all of the other education coaches with similar naming conventions. And taking a look now at the S&P 500 to kind of get a sense of what's going on. We'll just kind of center our thoughts here on this day ahead of the Fed. I'm going to zoom in a little bit and kind of take just a moment to take in this run that we've seen since April on the SPX. And we've run up, and we talked a little bit last week about kind of coalescing and kind of sitting right here above a resistance level. Now, this week we saw a couple of big days to the upside, and the last 2 or 3 days have really kind of been this more sideways movement. We've seen kind of this up and downedness. Yesterday was a little bit bigger red candle, but a little bit bigger red candle with some advancing momentum if we take a look at the RSI. So giving us perhaps that indication that there's a bit of a bullish divergence afoot. Not huge, not enormous, not substantial perhaps, but slight, a little bit of a bullish divergence. RSI ticking higher, but price kind of staying muted somewhat. And that isn't, I think, not at all outside the realm of expectation ahead of today's Federal Reserve meeting, which should be coming up here in about 2 hours or so. We should get that rate decision. Now, the expectation is largely that they will keep the rates the same, but you never know. Nobody expects the Spanish Inquisition, right? And as we get into other areas of the market, maybe there is a little more of an expectation. One of the things I happen to notice about the NASDAQ, this particular index, just from a market perspective, is we've seen some moderate rise in the RSI, seeing the RSI ticking higher today. Not substantially so. I mean, it's been up in that overbought range. But you notice the nature of these candles over the last few weeks going into the tariff deadline on Friday, the Fed meeting today, jobs reports, all of those things that are kind of piling up at the end of this week. And these candles have just been very muted, with the exception of yesterday. They've been very, very small incremental movements, not blowing the doors off of things and not increasing volatility. We'll take a look at VIX here in just a second. In fact, we've got a VIX index trade that I want to take a look at as an example that we will manage in this discussion. Take a look at the Russell 2000, though, where we talked about the Russell maybe seeing a little bit more volatility recently, especially a little bit more volatility going into this Fed meeting, because this is very likely the area of the market where that is going to potentially, if there is a rate change, come home to roost maybe a little more substantially. So we see a little bit more volatility here. A little bit less, however, momentum to the upside. So I think overall we could probably draw a bigger line here and just suggest, hey, maybe there is a little bit more of a bearish divergence in the Russell versus the RSI. Now, obviously, one of the things that we have discussed before is the fact that the market overall has a bullish bias. And when the market has a bullish bias, meaning it wants to go up simply because of the nature of business, if the market has a bullish bias and you see a bearish divergence against a bullish bias, that's maybe oftentimes more of an indication of a pause as opposed to a reversal, versus a bullish divergence in a bullishly biased market oftentimes can be an indication of an upward movement or a reversal in the market from down to up. A bearish divergence like we're seeing here maybe is more indicative of this type of pause that we're seeing in the Russell 2000. So that's kind of where we are index-wise. And let's jump in here really quickly to our VIX. This is the volatility index. Now, Shion McFarlane asks a question. News stocks or stocks and day trading the same thing? And the answer to that question is no, not necessarily. But the other answer to that question is we've got some great resources to help you out and to answer that particular question. So thanks for being here. We appreciate your joining us. But I want to take a look at what's going on with the volatility index here on the VIX. Starting to see maybe the VIX picking up just a little bit. Again, going into that possibility of some market moving events, the Fed, jobs reports, tariff deadlines, all of those things kind of running into this particular perspective where the VIX is starting to rise. Now, to be fair, the VIX is still pretty low. I mean, it's in the 16 handle. So relatively, it's below its typical average. It's below its 30-period average. It's below its 5-year average. 5-year average for the VIX is around the 18 handle. We're sitting at 16. So, we're 2 levels essentially below that level. Typical of a summer market, typical of some of those doldrums as the market continues to go higher. But as we have often talked about, the idea is notice what's growing here. Notice the disparity between VIX and VVIX is starting to pick up a little bit. The VIX is starting to get a little bit more volatile relative to the VIX. So its own volatility is starting to pick up. That may suggest, and that may be the reason why we're seeing in this particular grid that VIX starting to see a little bit of churn to the upside, a little bit of pickup, even though it's still relatively low. So that suggests a possible creeping back in of volatility. And remember, volatility, the VIX generally is a mean reverting instrument. When it is very low, when it is at an extreme, it tends to rise. And when it is at a high, it tends to fall very quickly. And I'll kind of give you that perspective. The angles of those two arrows are, I think, representative of the nature of volatility. It tends to climb slowly unless there's panic, but it also tends to fall fairly quickly once the exogenous event is removed that created the panic. Once it's an earnings announcement, whether it's a news announcement, whatever it might be. So trading in the VIX index, if we were to trade VIX options, which we've done, and in fact, we've got a trade on here at the moment, that in this particular example is looking for a rise in that implied volatility, may take a little while, may take some patience. But looking to sell against that rising VIX or fade the VIX, that may happen very, very quickly. So something to keep in mind as you put these trade ideas into practical application. Let's take a look. I'm going to pop over here really quickly to our monitor tab. And here's our VIX index trade that we put on a couple of weeks ago. It still has 20 days to go until expiration. This is a long call vertical. So our expectation is, if we take a look at where our strikes are, ultimately we want volatility in this particular case to go to or above that 19.5 handle. We've got about 20 days to go. This expires on the 20th of August. We're coming down into that time frame. It's now at that point where, time decay on the long leg is perhaps starting to eat away a little bit more. But notice what's happening to price. When I started looking at this morning, this was sitting at about 35 cents. Now, as that VIX picks up a little bit, as implied volatility rises, as the VIX, the VVIX, the volatility VIX rises, that's having a tendency to make this spread a little bit more expensive. And that's exactly what we want to have happen. We bought it for $1.35. We want to be able to sell it for more. So let's do this. Let's go back to our grid here. And I have my index grid that we've used before, our index options grid. And it is simply a 2-chart grid. On the left-hand side, looking at a longer-term chart. On the right-hand side, looking at a shorter-term chart. And I'm just going to plug in VIX into that chart. Now, one of the things to think about is that the VIX, we know, because it's not a tradable instrument, and B, it is representative of something that is not directly related to buying and selling activity in the index or in the component of the index. It's related to implied volatilities of or prices of options across a cross-section of in the money, at the money, out of the money options over a 30-day time frame on the SPX. It doesn't necessarily behave in the same way that we would normally view levels of support and resistance. That doesn't mean that we can't look at this and kind of get a sense of what's going on, because we can get some momentum indications here. And we see that momentum definitely has slowed, but there is the potential for this to certainly move higher, and especially if going into the Fed meeting today, or if coming out of the Fed meeting in that statement, there is perhaps some ambiguity about what might happen in September in the September meeting, or what might happen at the Jackson Hole Conference, which is the next kind of official event up on the Fed's calendar. That may create a little bit more volatility overall in the market. That little bit of volatility overall in the market is something that we want to pay attention to, because as we go back to this spread, this example, we want volatility to rise. In this particular case, we are trading that expectation of volatility rising to or above the 19.5 handle. We want both of these legs to be in the money at expiration. And simply from that standpoint, we really do expect some expansion of volatility. The challenge is, if if VIX is rising, that's elevating implied volatility. Well, that's also perhaps adding to the value of this spread. We want this spread to get as expensive as possible, as quickly as possible. If we were to close it down right now, 20 days to go until expiration, we're taking a little bit of a loss. We theoretically would be taking a little bit of a loss in this particular trade. If we were to right click, create a closing order, we bought it originally for $1.35, we could sell it for 98 cents. So since we still have a little bit of time, we're going to let that one go, and we're just going to kind of keep that with that expectation the volatility is likely to rise. Now, on the other hand, let's take a look at another example that we have here in place, which is the Russell 2000. And in this particular case, what we've created is a short call vertical spread. And again, remember, keeping in mind, let's take a look at MRUT. We could also look at RUT, the Russell. Remember, we were looking at this kind of staying at or maybe below a particular level. So let's look at where our strikes are here in this case. 225, 227 on the MRUT, which is the smaller of the index products in this particular case. The problem is, the challenge is, this trade expires today. We knew for sure that we were going to run into an expiration date at this particular point. So right click, create a closing order. We want to be able to buy this back as cheaply as possible. Well, unfortunately, we sold it for 59 cents. Right now, if we were to buy it back, we're buying it back at 90 cents. So Bob asks a great question. Is there likely a vol crush on the VIX after the Fed announcement and the press conference? Yes and no. And here's the reason why I say yes and no. One, this is kind of a unique situation where we have backstopping immediately after the Fed announcement today. We have the tariff deadline on Friday. We also have jobs numbers on Friday. We have JOLTS numbers tomorrow. So we have a fair number of market moving potential data points that are coming immediately on the heels. So to say, all right, look, if the Fed meeting were just that one discrete particular point in time, then likely, yes, we would see a collapse in implied volatility. But since there is that possibility of more movement in the market, my suspicion in this particular case, simply from kind of putting all of these things together, would suggest that maybe implied volatility is likely to stay or likely to continue to elevate, not necessarily crush terribly, right? So Siri asked a question, and this is kind of getting into perhaps some of the thought process around that. How is not cutting Fed rates on Friday going to impact markets? Well, if they don't cut rates today and they don't say anything giving some guidance about what potentially rates might do in September, which is the next meeting where there is a rate decision, then that could create some additional volatility, right? We could see a volatility spike. And that would then likely push. So we're threading the needle here, guys. We really are. That could likely create a little bit of a volatility spike if there is ambiguity or more ambiguity about what's going to happen in September, and they kick the can down the road in terms of rate cuts once again. Because rate cuts, remember the premise here in terms of the MRUT and the Russell 2000 is that a rate cut would be beneficial to the small caps. So ambiguity about a rate cut would be detrimental to the small caps and would also likely raise implied volatility. So we're sitting on a trade here at this particular point. And the reason I'm talking about this and spending a little bit of time here is we're sitting on a trade that has the potential to do what we want it to do, which is to see the Russell go down, but at the same time see implied volatility go up. So there's a challenge in this particular trade. So my thought was this: given the fact that we're at zero on the DTE counter, days till expiration counter, that means this trade expires today. What if we were to do our own kicking of the can down the road here a little bit, with the expectation being that maybe that gives us a little bit more duration. Now, it may very well cost us, but we want to think roll it for a credit, or just forget it. So let's see what we could do. We're going to roll this vertical spread. Now, we could diagonalize it, but we got to roll it anyway because our long leg, this was a vertical spread, so it both expires on the same expiration. So in order to diagonalize it, we would have to roll out our long leg even further and then roll our short leg. But what I'm going to do is I'm going to create a rolling order here, and by default, this is going to roll to the next expiration. And remember, if we take a look at the trade tab here for MRUT, we've got some daily expirations. So if we were to roll this, we may look at rolling, say, for instance, out another week, maybe out to the 6 AUG expiration. So we're going to have to do that manually as we create this roll. So we're going to go back to the monitor tab, right click, create a rolling order, and we're going to sell this vertical roll. Now, the reason we're selling it is because we sold the vertical spread to begin with. So we got to buy it back and then sell it again. And hopefully there's enough premium in these strikes a week out that we're able to sell this for a credit. Now, that's rolling it to tomorrow. Kicking it down the road just one day, I don't know is far enough in terms of kicking it down the road. So that's why I'm saying let's kick this out to the 6th of August at roughly the same strikes. And the Russell currently sitting, as we said, in this particular case, if we go back over here to the charts, the Russell currently sitting at 225. So we're right about at just a little bit inside our short strike here. So we'll go back to our trade here. There's the potential to roll this out for about a 13-cent credit. I mean, we might get 13 cents in practical reality. If we can roll this for a push, that's fine. If we can roll it for a credit, that would be better, because then we are essentially bringing in a little bit more credit. The bar to closing this down goes down a little bit in terms of having to buy it back. So what we're going to do is I'm going to go ahead and confirm and send. We're going to read through this order. And again, remember, rolling is not a magic wand by any means. It does not eliminate transaction costs. It simply makes it more convenient to be able to accomplish what we want to accomplish in one single order, as opposed to doing it in 2 single orders. So there's still going to be transaction costs, theoretically. There's still going to be, challenges in terms of liquidity. It doesn't erase that. You have to have a liquid target in order to be able to make that roll work. So we're going to go ahead and we're going to try to roll this for about $13 or so, bringing that credit in. We'll see if that works. We might have to bump it a little bit, the MRUT a little bit less liquid for sure than, say, for instance, the big index, but obviously smaller notional value in terms of this particular index, the MRUT versus the Russell 2000. If we were to change this to the RUT index, you can see that this is 10 times the MRUT. Same movement, same perspective, because it's measured off of and moves off of the same information. But MRUT is simply a tenth. It's a smaller notional value. Let's go to the monitor tab here really quickly. Let's take that working order and let's kind of bump this a little bit and see if we can work the order and try to get that to move. So I'm going to go ahead and click on cancel replace. We're going to open up that lock. And like I said, we may not get this for a credit. So if we could do it for a push or no credit at all, but no cost to us, that might be beneficial as well. So when I say roll it for a credit, or at least not for debit in this particular case. So I'm going to put this back in our index options group. I'm going to open that up a little bit by opening up that lock on the order, and we'll push this out and we'll see if we can get that to fill. And again, this is one of the challenges with rolling, especially as we get down to the last day to go until expiration, because we are essentially rolling out of a 0 DTE option, one that is in its last day to go until expiration. So there may not be a lot of liquidity there in terms of, or a lot of appetite in terms of, especially in a lower liquidity, how to buy that back. All right. So we'll put that out there. We'll see if that works. Now let's go back to our charts tab and to our index grid, and let's bring up the SPX and take a look at what's going on here on the SPX. Still well above the 200 period moving average. That's our 200 period moving average over on the left-hand side. We can see that this index is up 31%. And we can see that move month to date is 2.76% up on the month, 16% on the year. Year to date, 8.41. And since the 52-week low, up 31%. So it's made a pretty big move. But implied volatility is starting to rise a little bit. Now, what that means is we're probably likely to collect a little bit more premium. Let's go to the monitor tab and let's take a look at this particular trade. So I'm going to close down that MRUT trade. We're going to take a look at the SPX. Here we are, 7 days to go until expiration. We sold this a week ago. We sold the 6140, 6120 put spread, bullish spread. We sold it for $2 times 100 shares, $200. We can now buy it back for 70 cents. The idea behind this particular strategy is we capitalize on not only price direction move, but the rapid decay in extrinsic value in an out-of-the-money spread at the outset of the trade, as opposed to towards the end of the trade. So that's the reason why we're selling it at 14 days out and buying it back at 7. And the way that we've approached this is buying it back come what may. In this particular case, relatively successful. So what I'm going to do is I'm going to right-click and I'm going to create a closing order. Now, essentially what I'm doing is a roll, but I'm doing a roll in 2 parts, which is just closing the first one out and then selling another one. So I want to talk through this. So we're going to buy this one back. If we can get it for 65 or 70 cents, great. That's perfect. We're going to click on confirm and send. We're going to read through this order, make sure that this is what we want to do, make sure that it is to close. We're going to close this down. So we're paying very little to close this down relative to what we brought in. And it's done a fair majority of the work that it can do for us, but we're not going to get to maximum theoretical gain on this particular trade. So we're going to click on send, fire that order off, see if we can close this down. I'll tell you what, there is not necessarily, as this market kind of sits here, there's a bit of wait and see going on at the moment. So if we come back up here to our working orders, we might have to be willing to open up that lock and pay a little bit more, maybe even pay up to that 80-cent range to close this down. And that might be okay, simply because that's what we want to do, is be able to close this down and then move on to the next one. So click on confirm and send. We're going to bump that order up a little bit and kind of move it, nudge it a little bit, if you will, to try to close it down. We're going to click on send and we're going to fire that order off. Now, again, we got it for 80 cents. We paid 80 cents for it. That's okay in the big scheme of things, because remember, we brought in $2 against it. So we had to work that order a little bit. And again, that's also a function of rising implied volatility and other factors. Now, same premise. We're going to go back to that chart and we're going to say, look, first question, is the price of this index still above the 200 period moving average? Yes. So next question is, when is our 14 days to go until expiration date? It is the 13th of August. So we're going to go back to our chart. We're going to take that one off. That's our time hack. On the right-hand side of this chart, I've got a probability of expiring cone. That probability of expiring cone is 1 standard deviation, and it expands or contracts based on implied volatility. So if implied volatility is going up, that probability of expiring cone is getting further apart. Those edges of the probability of expiring cone are getting further apart because it's representative of 1 standard deviation based on implied volatility. So now what I'm going to do is I'm going to put a time hack here. I'm going to use our time level, and we're going to go out to the 13th of August. That's right here. And we're going to put that time hack in place, and you can see where that line is. So now what I'm going to do is I'm going to grab my trend line tool, and I'm going to draw a line here right at the intersection of those 2 tools. And we can even zoom in if we want to get a little bit more precise. So I'm going to go to 61, or I'm going to call it 6180, and I'm going to draw that line right there at 61.80. So right about there, 61.80 is where that level is. You can see that implied volatility. So two things have happened. One, the index has gone up. Two, implied volatility started to rise. So that's why this level that we're selling at is very close to the level that we sold at last week. So that's our cross section. So 61.80 is what we're looking for on our option chain. I'm going to go back over here to the trade tab. We're going to look at our 14 days to go till expiration. That's the 13th of August. I've got 100 strikes in here, and we're bullish. Remember, the price is still above the 200 period moving average. So we're still selling put spreads in this particular case. And so we're going to go to the 61, what did we say? 61.80 strike. So let's go back to our trade tab. 61.80. We're going to look at selling the 61.80. I'm going to change this layout to Delta Theta Vega. So 61.80 is going to be right here. It's about the 15-cent delta, which is around where our short leg has been falling. So we're going to sell the 61.80, and to be consistent, we're going to go 20 wide. So we're going to buy the 61.60, and we're creating a short put vertical spread. The short put vertical spread in this particular case, even though it's closer, we're a little bit less. We're about 10 or 20 cents less than the premium that we brought in last week. And this is entirely dependent on that implied volatility level, because we're just about at the same delta. So if implied volatility has stayed about the same, contracted or gone down, we're about the same level as where implied volatility was last week. Even though in the short term, in the last couple of days, implied volatility, the VIX has gone up just a little bit. So let's see if we can get a $1.90 for this vertical spread. The first thing I'm going to do, however, is I'm going to send this over to the Analyze tab just so that we can see what this looks like. And so I'm going to just do this. I'm going to hide positions, and I'm going to say, all right, what does this vertical spread in and of itself look like in terms of our expectation? We want this to stay out of the money at expiration. We want it to be out of the money. In this particular case, we want the price of the index to keep going higher. You can see that probability range. If we were to expand that probability range to the 13th of August, that's this one right here. We're going to go to the day after. You can see that the vast majority of that light shaded area falls in the max theoretical gain range of this particular trade. That's exactly what we want to have happen here. We want this trade to be out of the money at expiration, but we also recognize that if we were to come back in here and take a look at this and click on confirm and send, that we've got a pretty substantial max loss in the trade. But we're willing to accept that given the probabilities. 15-cent delta, that's a 15% probability that that short leg is going to be in the money at expiration, theoretically. We've got a trend direction that's moving in the direction we want it to go. We've got lower implied volatility. So we've got a lot of factors working in our favor from that probability standpoint. Highly probable trade, lower potential return. Doesn't mean that it can't give us a maximum theoretical loss, because we in fact have taken maximum theoretical loss on this particular trade strategy a couple of times when the market has moved substantially. It moved substantially for us, against us, actually, in April. It has moved substantially against us a couple of different times, but we're trading that bullish direction. We're trading a bullish trade. We're trading it far out of the money. Not a guarantee by any means, but it gives us that opportunity. And so I'm going to go ahead and we're going to click on send, and we're going to fire this order off. And it filled for $1.90. We got the trade for $1.90, which is exactly what we want to have happen in this particular case. Now, one other thing I wanted to look at in this scenario, so let's kind of close this down. Let's come back down here to our weekly index option. So here's our vertical spread. We sold it for $1.90. We want to be able to buy that back as cheaply as possible if we can. All right. Now, Jerry says, well, wait a second. Why wouldn't we maybe wait until after the Fed passes to put the trade on? The risk that we run in that particular case is that we do get an implied volatility crush. And so there's just not enough premium to make that trade worthwhile. That is a possibility. But it also might then automatically shrink the probability of expiring code if that implied volatility crash happens. Depends on when they pull that implied volatility out of the option premiums. So we could certainly wait to place this trade. Unfortunately, the only time that I have to talk to you guys is right now. So rather than waiting, I want to do it right now. Your mileage may vary. Again, these are never recommendations. These are simply illustrative and educational opportunities. So here's what I'm going to look at now. I'm going to take a look over here on our charts. I'm going to take a look at NDX. Whoops, not NDX. There we go. And my thought was, in this particular case, NDX, we've seen some upward movement. I want to look at, again, that possibility. If we see jobs numbers that are good, if we see a Fed meeting that's good, if we see kind of that JOLTS information and the continuation of some of the trade deals that have been happening in light of the August 1st tariff deadline, which have been driving this moving to the upside, I want to look at a shorter term calendar spread with lower and rising implied volatility. But this is a little bit of a challenge because calendar spreads normally depend on some kind of rise in implied volatility. I have a bullish expectation here, so I'm likely looking at a call calendar, but a call calendar isn't going to benefit from rising implied volatility as much, and it's not going to have significantly as much rising implied volatility if the market is moving or this index is moving higher. Nevertheless, I want to see if the index drifts a little bit higher, perhaps up here to this 23, we'll call it 23,470, kind of at the top of that candle. Or actually, let's even make it kind of a round number, 23,500. So I'm going to go to the trade tab, and we're on the trade tab for the NDX. And so what I want to look at is I want to look at a little bit higher implied volatility and a little bit lower implied volatility in the back month or the back expiration. So in this particular case, I want to kind of go out to next week, a little bit beyond, but I want to go not terribly far. So actually, I want to even go in this particular case because there is still some elevated implied volatility. Let's go to the 1 August expiration as our front leg. And so I want to create a calendar spread. And if you remember, a calendar spread is going to benefit from not only price kind of drifting and staying in a particular area, but it's generally going to be a lower cost to enter. Doesn't mean that it's going to be a cheap trade. It doesn't mean that you can't take a loss. It just means that it's generally a little bit lower cost to enter the trade. So 23,500 is what we were looking at. It's about the 36. Is that right? 23,500 is what we were looking at. Yeah, 23,500. So go back to the trade tab. 23,500 is the strike that we're looking at. So we're going to look at selling perhaps that 35 delta, 23,500 strike, 2 days to go until expiration. And at the same time, coming out and going to next week. So let's go to the next week. Let's go out to, say, for instance, this date next week. Let's go out to the 7 days to go. Now, this is a shorter term time frame on this particular trade. So again, attention must be paid. This is not a set it, forget it. No trade really is. But we're going to go out to the 6th August. We're not looking into trying to roll this trade necessarily. We're looking at this being a one and done calendar as opposed to rolling the calendar. And so I'm going to come in here and I'm going to sell, or now I sold or created in order to sell the 23,500. Now I'm going to buy the 23,500 in this case a week from now. And buying that, I'm going to create a $44 or $46.60 debit times 100 shares. So this is going to be lower cost, but the expectation is that if we're buying this, we're going to be able to sell it for more if the market continues to move higher because we're doing those calls. So I'm going to do this. I'm going to click on Analyze Trade, and I'm going to put this calendar in here, and that's what our trade kind of looks like here, is this calendar spread. Now, we could do a lot of things with this. We could diagonalize it by extending the duration. We could, you could turn this into a ratio spread. If you had more of a bullish expectation, you could buy 2 and sell 1. And then we would have what we might refer to as a zebra type of trade. But in this case, we're buying 1 and selling 1. We create this expectation that the price of the index is going to get to 23,500 in 2 days. and that's where it's going to end up. Theoretically, if we can get maybe half of a doubling, right? So doubling this would be if we were to take this and just kind of look at the price. So if we were to double this price that we're paying for it, that would be 100% gain. We're not going to get 100% gain theoretically. So if we were to do this, 4680 times, whoops, let's do this again. 4680 times 2 is 9360. Now, if we were to divide that by 4, that's going to give us 2340. So let's do this. Let's add 2340, which is essentially 25 or excuse me, 50% gain, because $46 would be 100% gain. So $23 would be 50% gain. Let's take 2340 plus 4680, and that's 7020. So what we're going to do is we're going to come down to this order. So I'll pop this order up in the page, in the order entry box, change it from single order. We've done this before, and now make it a first trigger sequential. And then right click, create an opposite order. And I've done this before, and we've also got some great webcast videos that show how to do this. And then I'm going to create an order to sell this back. If I can sell it back for 70, 20 or better, we'll make that good till canceled. That way, if we get a spike in implied volatility, or if we get a move to the upside, either way, it's going to make this spread more expensive. We're buying it to begin with. We want it to get more expensive. We want to be able to sell it for more. So we're not looking at getting max theoretical gain on the trade. We're looking at getting about 50% of max theoretical gain, and we can even attenuate that somewhat from there. But we're putting an order on. Now, there's no guarantee this is going to fill. The loss in this trade is what we're paying for the trade, however, theoretically. So I'm going to click on confirm and send, and I have that potential to gain about 50% in the trade. That's what this order is setting up. And we're going to put this back in our index options, and we're going to trade this calendar spread. Let's see if this works for us. So we'll come back and revisit this next week. Now, that might not fill. We might have to bump that order like we've had to before with others. And if we have to do that, we can do that in terms of that pricing. So, and volatility is, but remember we talked about the fact that implied volatility might continue to spike given some of those other data points. So we're taking advantage of the possibility of implied volatility rising in this particular case. So guys, again, one of the things that you may want to pay attention to in looking at index options trades, especially things like calendars and verticals, is what your directional expectation is and what your implied volatility implication is. So great opportunity for you to learn a little bit more. Go to our Trader Talks webcast page, youtube.com/Trader Talks webcasts. When you're there, click on subscribe. And that also can be a very helpful tool in helping you to continue to learn more about these particular strategies. Once again, my thanks to James Boyd. My thanks to all of you for asking questions. Our thanks to our great reviewers and production staff for helping out with this webcast today. I will see you guys again very soon. Check out our X handles at Ben Watson CS, at James Boyd CS. Love to have you follow us over there as well as on here on that subscribe button. Click on the like if you happen to like what you see today. We'll talk to you again next Wednesday. Take care, everybody. Bye-bye.